Annual revenue has surpassed $20 billion, yet it's still seen as a hidden chip giant. It holds the strongest demand for compute power, yet is forced to turn away major clients trying to buy out its capacity. In 2026, Amazon is launching an unprecedented $200 billion capital offensive into global AI infrastructure. So what is this real-life final straw-crushing cash flow, or a nonlinear ticket to dominance over the next decade? Behind what looks like a pricey 3-2x divided by E, the upcoming earnings report will be the ultimate stress test for this massive bet. Hey everyone, welcome to Stock Market Breakdown. When people talk about Amazon, if you're still focused only on e-commerce, you might be missing a $50 billion chip unicorn. Today's Amazon is undergoing a fundamental transformation. From the overwhelming demand for its in-house Graviton chips to a record-breaking $200 billion investment push, the long-term mindset left behind by Jeff Bezos is evolving aggressively in the Amazon's internal chip business, including Graviton, Trainium, and Nitro has quietly crossed a $20 billion annual run rate, and is growing at a triple-digit pace. If spun off as a standalone company, its valuation could easily approach $50 billion. This means Amazon is no longer just the world's largest cloud provider. It has already scaled into one of the top-tier chip design players globally. You have to understand what that $20 billion really means. That's already bigger than many traditional semiconductor giants. Amazon isn't building chips for fun, is doing it to take full control of costs. While everyone else is lining up to buy NVDA, Amazon is building its own moat. This level of vertical integration gives it a pricing advantage in compute that other cloud providers simply can't match. In his shareholder letter, the CEO revealed a luxury problem. AWS is currently operating in a state of extreme supply shortage. In fact, two major clients even attempted to buy out all available Graviton capacity, but Amazon declined. This shows that AWS growth is no longer constrained by demand, but by how fast Amazon can build data centers and expand infrastructure. Customers begging to buy out your entire capacity, that's extremely rare in cloud history. It proves Amazon's in-house chips have already validated their cost-performance edge. The bottleneck now is physical transformers, facilities, and power infrastructure. As long as Amazon can build fast enough, the revenue is essentially locked in. To meet this explosive demand, Amazon plans to invest around $200 billion in capital expenditures in 2026, with a major focus on AI infrastructure. While this will heavily pressure short-term free cash flow, the company emphasized that most of this investment is backed by committed customer demand. This is not blind spending, it's a scaled expansion driven by visibility. $200 billion, that's the GDP of some countries. Amazon is betting on an entire era. In the short term, the financials will look ugly, and it might scare off conservative investors, but what matters is return on investment. If every dollar spent already has contracts waiting behind it, then this isn't a burden, it's a prepayment for future profits. The CEO described Amazon's growth as nonlinear. This means the company is willing to sacrifice short-term profitability to secure long-term dominance through aggressive investments in robotics, satellite communications, and AI. This experimentation-driven model signals that Amazon is no longer aiming for steady growth, is targeting generational leaps, even if it comes at the cost of near-term margins. What does nonlinear growth mean? It means today's 1 + 1 isn't meant to equal to, it's meant to build toward 100. Whether it's Project Cooper satellites or logistics robotics, Amazon is extending its reach into every corner of the physical world. This model requires patience, because before the explosion comes a long investment phase. If you understand that, you understand everything Amazon is doing right now. By scaling adoption of Graviton and Trainium, Amazon is systematically reducing its reliance on expensive external suppliers as in-house chips take up a larger share of its data center stack. AWS cost structure is expected to improve significantly over time. This margin resilience will become a powerful competitive moat. giving Amazon the flexibility to win future pricing wars in compute. This is essentially NVDAization. NVIDIA's chips are great but they're expensive and supply constrained. By building its own, Amazon lowers costs and can tailor solutions for its clients when margins are no longer dictated by upstream suppliers. AWS can unlock even stronger cash generation. That margin expansion is one of the core reasons the valuation still makes sense. Amazon currently trades around $250 per share, with a forward divided by E of about 3-2x, while the PEG ratio suggests a premium. The resurgence of high-margin AWS growth makes this valuation appear reasonable. Among 58 analysts covering the stock, the consensus rating is strong buy, with the highest price targets implying up to 44% upside over the next year. Is 3-2x divided by expensive for a company dominating both global cloud and e-commerce. In the AI era, not really. The strong analyst consensus shows the market is waiting for that inflection point in profit expansion. At $250, the market is essentially pricing in future compute dominance if high-margin segments continue to grow. Valuation compression could happen faster than expected. The biggest risk for investors is timing mismatch. The capital is being spent today, but the returns would take years to materialize if AI-driven revenue growth under-delivers or cost improvements lack expectations. The stock could face significant volatility due to short-term margin pressure. This is not just a test of execution, it's a test of investor patience. This is the real risk if you're focused on short-term earnings. Amazon might be uncomfortable to hold right now. The $200 billion spend will weigh heavily on financials. And we have to be honest, if AI adoption slows down, these massive data centers could turn into stranded assets. That's the trade-off every AMZN investor has to accept. The upcoming Q1 2026 earnings report will serve as the ultimate test of Amazon's high-spending strategy. The market will be watching closely. Is AI demand translating into real revenue? How much are margins being impacted by CAPEX? This report will determine whether investors continue to believe in Amazon's nonlinear growth story. At the end of the day, Amazon is evolving from a company that sells products to one that sells compute infrastructure. The $20 billion chip business is the foundation, and the $200 billion investment is the ambition. So the real question is, can Amazon use its in-house chips to turn massive spending into a profit machine? Drop your thoughts in the comments, like and subscribe to Stock Market Breakdown. You'll see you in the next one.